Good morning and welcome to another edition of Energy Action's Market Wrap. My name's Scott Easton and I head up the trading and pricing team here at Energy Action. Today I'd like to spend some time to focus on AEMO's administration of the South Australian electricity market. But first, let's begin with an update on the key issues impacting the electricity and renewable certificates market. System demand increased across all states except Queensland and Tasmania. Significant increases were observed in Victoria and prices were capped at $300 a megawatt hour in South Australia during the past week. Spot prices responded to changes in system demand and the interconnect outage between South Australia and Victoria. New South Wales, Victoria and South Australia all experienced a significant increase in average daily spot prices, while Queensland and Tasmania prices remained steady. The frequency of pricing exceeding $300 a megawatt hour increased primarily due to the Vic SA interconnect outage. Victoria reached the maximum price of $14,700, also referred to as vol pricing or the value of lost load, while New South Wales and South Australia traded near vol pricing at $12,000 per megawatt hour. South Australia experienced 82 negative price events as a result of its inability to export to Victoria. All states, excluding New South Wales, experienced negative price events. South Australia and Tasmania recorded minus $919 and minus $884 respectively, primarily due to the Vic SA outage. So what is an administered market? Market administration refers to the Australian energy operator's role to step in and suspend market pricing in either the spot market or the market for ancillary services. The trigger for this is when spot prices reach a cumulative value of $221,100 within a 7-day period, or the cost of ancillary services exceeds 6 times the cumulative threshold. When this happens, AEMO substitutes the market price based on supply and demand for an administered price cap of $300. Since the 1st of January, South Australia has been in an administered market for ancillary services. This means the cost of generators providing services such as frequency control and reserve generation capacity has been capped at $300. We're already warning our C&I customers to expect their February invoice charges to increase as a result of these higher ancillary service costs. Now let's move to a brief update on electricity contract prices. As discussed last week, we're continuing to see large discounts for 21 and to a lesser extent 22 electricity supply agreements. Remember, even if you've signed a 20 or 21 contract when the market was trading higher, you can use an option called Blend and Extend to average down your electricity prices over a longer contract period. We recommend you talk to us about the best option to take advantage of all-time low pricing. Energy Action can structure an option to reduce your purchase costs, enhance your sustainability and improve the value of your business's assets. Now moving to the gas market. As discussed last week, we are continuing to see favourable movements in East Coast gas pricing. We believe this is due to a combination of factors such as lower gas export demand, economic conditions and the potential for an East Coast domestic gas reservation policy. This would mean 15% of gas supply would be reserved for the domestic market. In practice, this policy manages how much gas can be exported, because the more supply available to the domestic market, the greater the export quantity. Now turning to the certificate market, the Australian energy market operator temporarily shut down some wind farm assets in South Australia as a result of the interconnect outage. This reduces the expected supply of LGCs and places upward pressure on LGC pricing, trading briefly at $46 per certificate, before dropping back to current prices of $33. Future LGC prices remain significantly below current pricing, with 2023 LGCs trading at approximately $10.50 per certificate. In other certificate markets, STCs remain stable at $38, ESCIs have increased to slightly above $26.50, and VEECs are trading at $35. In the news this week, following the dramatic weather events on Friday the 31st of January, AEMO shut down the interconnect between South Australia and Victoria. This has brought significant volatility in the spot market, since the excess renewable generation in South Australia can't flow into Victoria or indirectly into New South Wales. AEMO has temporarily shut down renewable wind, which resulted in an administered market and a jump in the ancillary service costs and a short-term increase in LGC pricing. In other news, the electric vehicle industry is encouraging Australians to follow the UK's ban on purchasing petrol, diesel and even hybrid cars by 2035. Industry analysts say if Australia were to adopt the target, there would be a significant increase in demand for off-peak electricity to charge electric vehicles, and suggests a greater emphasis towards wind rather than solar. Well, that's it for this week's Energy Market Wrap. I'm Scott Easton for Energy Action, and as I always say, don't pay too much for your electricity.